Every day, every single day, things are happening in the world of deals and deal makers. And there's never enough time to keep up with every company, transaction, announcement, or whatever. It's just exhausting. And we have a new product to help fix that. This is Axios Pro Deals, a new premium subscription product bringing you tailor-made insights like never before. For the last 5 years, Axios has helped deal professionals navigate the whole deal landscape with Pro Rata. With Axios Pro Deals, we're diving deeper into the industries that matter most to you. You just want stories on fintech? There's a newsletter for that. MedTech deals? We've got you covered. The future of retail? We'll guide you. With Axios Pro Deals, you're going to be getting all of this industry-specific insight and expert analysis at a level you simply can't get anywhere else. So if you're a venture capitalist, private equity investor, banker, trader, founder, executive, anyone who cares about deals, Axios Pro is what you need to help you understand what matters and why. Start your free trial today at axiospro.com.
Welcome to today's Dealmakers event on the M&A Forecast. I'm Kia Kokolacheva, a technology and business reporter at Axios, and I'm coming to you today from San Francisco. Welcome to our audiences on Facebook, YouTube, X, formerly Twitter, LinkedIn, and on Axios.com. Join the conversation today on X with @Axios and hashtag Axios Events. For our second installment of our 2023 Dealmakers series, we'll be looking at the predictions, trends, and expectations shaping the landscape for M&A through the end of this year and heading into 2024. Our first guest is partner and head of Bain & Company's Global and America's Mergers and Acquisition Practice, Les Baird, joining us from Boston. Hi, Les. Welcome.
Hi, Kia. Thanks so much for having me.
So jumping right in, over the past year, we've heard from a lot of experts that now's a good time for strategics to come in and buy companies at prices that they may not have had access to before. Do you think that companies and strategics have been doing that? Have they been taking advantage of this opportunity?
Yes, absolutely. We've seen corporate M&A buyers for sure fairly active right now. As you understand, there's maybe a paucity of assets coming to market relative to the highs of 2021. But for those that are coming to market, the corporate players actually have relatively strong balance sheets. They've got an opportunistic time to look at deal processes when there's potentially less competition from financial sponsors. And by and large, they've been very assertive. We're probably still wrestling a little bit with some of the valuation considerations. Our banker friends like to talk about the bid-ask spread. That's probably narrowed a little bit. But by and large, it's been a great time for some of the more aggressive deal makers to be in the market.
How would you compare M&A in this downturn compared to prior downturns?
Great question. We were studying the data. We publish on this fairly often. It's interesting. We have not in the last 25 years seen 3 years of sequential M&A corporate markets down in a row. This will mark the second year of downturn. If you look at what's happened over the last, call it 16 months since the Fed intervened with a bit more hawkish stance in June of 2022, deal transaction volumes for corporates on a monthly basis have averaged about $175 billion a month, and they've gotten increasingly consistent. So there was volatility right after the Fed intervened. Since then, it's actually gotten close to about 175 billion per month. And so we saw, relative to prior downturns, a very fast contraction. There's been some stability here in the M&A markets. I think the buzzword of the day remains uncertainty. Uncertainty in and around inflation, uncertainty in and around the depth of a potential recession, and when we might see a bit of a correction.
So would you say that uncertainty has a bigger impact on M&A activity than the actual level of the interest rates? Because I know that was the big conversation, 18 months ago.
Yeah, great question. I mean, I think if you look back historically, 15, 20 years ago, rates in similar ranges, we saw still quite a few deals getting done. Relative to today, I would argue that we found a bit on the corporate side, perhaps a bit of a floor in terms of transaction volume. At least that's an optimistic floor. What we don't have yet is real clarity around whether or not the central banks in the US and in the Eurozone and in the UK feel like they've done enough on inflation. We don't have clarity yet on the degree to which recession is coming, the depth and duration of that recession. And there's still a little bit of uncertainty that's kind of contributing to it in and around the regulatory environment. And when you put all three of those things together, that uncertainty angle makes it very hard to think about how you calculate and forecast potential impact on earnings that deal makers need to do to underwrite a deal.
I'm going to get back to regulatory in a second, but have there been sectors that have seen more activity or more consistent activity and been less impacted by the downturn than others? And if so,
Yeah, great question. Probably the two that we've seen the most contraction in over the last 2 years are in the tech sector, which you're obviously very aware of. It was exciting to see just recently in the last month or so, a couple of larger tech deals get done. We also saw contraction in healthcare deals. And so those probably were the two that were, perhaps hit the hardest. We have seen sort of steady undercurrent of deals in and around industrial sector that's remained strong, energy and natural resources. And then we've also seen a little bit of a pivot towards more scale-focused deals recently. The last 5 years had been a bit of a trend towards scope deals.
So back to regulation, especially antitrust, that's always top of mind. Tell me how the last several months have really been impacted by that. The DOJ and the FTC came out with new proposed guidelines. They've just the FTC under Lena Khan has been much more aggressive about M&A. So how has that impacted it in the last few months?
Great question. The regulatory regimes have been certainly winning in the public press, maybe a little bit less so in the courts, as we've seen with some of the rulings. That notwithstanding, we certainly see a little bit of a caution in the boardroom as a result. And I would say from our standpoint, we see companies maybe doing three things practically. One is just really getting their arms around how the updated merger guidelines are going to impact deals kind of going forward. Starting to figure out which types of deals attract more regulatory scrutiny, thinking about how a regulatory response needs to factor into when they make offers, those kinds of things. They're also starting to look a little bit forward down the line around when additional scrutiny is anticipated. And they're doing things like some scenario planning in and around deals. They're starting to amend agreements and adjust timelines to bake in expectation of longer close periods. That means things like how to protect that base business that may take a 12 or 18 months before it can close. And then lastly, and this is maybe earlier stage, they're starting to think about what the new HSR requirements might need to be as they prepare to file. So there's actually a lot of activity, I would say, within corporate M&A and legal departments to get their arms around these topics.
Well, it's 2023, so we can't not talk about AI, the word of the year. How is that coming up in deal making, or is it just coming up in conversation, sort of generally? Are you seeing more companies trying to acquire AI capabilities to stay ahead of the curve? Like, how is that coming up?
Yeah, I think it's early in the curve for acquiring AI capabilities. We certainly see a lot of interest in that. Frankly, I think companies are still trying to figure out how to value and then how to think about using and integrating and deploying those kinds of capabilities as they acquire them. Obviously, very nascent. One thing that is interesting is companies are also thinking about how they can use AI in service of applying it to their own deal processes. And so that's another, important vector, also very nascent, but one that your more sophisticated acquirers are starting to think through.
Interesting. Okay, so replacing the corp dev team with some AI, that'll be interesting. Um,
Not fully yet, though.
let's talk about 2024. What are your predictions for next year in M&A?
Well, our hope is, as I alluded to, that there's some stability on the corporate side, that, the last 16 months or so post-Fed have been, relatively stable, a few months up, a few months a little bit lower, but somewhere in that $150 billion to $175 billion range. We're hoping that some of the green shoots that we're seeing in and around things like IPO markets and some of the more recent deals that have gotten done in September might allude to the valuation disconnects perhaps starting to get resolved in some spaces. And then, we live in this moment where our market is really policy driven. And so government action on interest rates, perspective on inflation, the view on the depth and impact of the recession, the degree to which antitrust regulation really does kind of ripple through the market in 2024. All of those things have the potential to be accelerators or dampeners for M&A markets. I'll go back to my opening comments, which are we haven't seen more than 2 years in a row of down markets in the last 25 for M&A. So we're cautiously optimistic, and we're hopeful that this will be the year in 24 when markets start to turn back up.
Well, it sounds like we're going to have to catch up next year and see what happened. Thank you so much for being here with us today.
Kia, my pleasure. Thanks for having me.
And next we have a View from the Top segment with my colleague Fabricio Drummond.
Hi, I'm Fabricio Drummond, Axios Chief Business Officer. Thank you, Cooley, for making this conversation possible. Up next, we have Kevin Cooper, partner at Cooley. Kevin, welcome to Axios.
Thank you. So happy to be here. Looking forward to talking to you today.
Thanks for joining us. Kevin, let's start. M&A this year was very choppy for M&A. We have seen an uptick in activity. However, valuations, multiples have declined substantially. Do you think these trends will continue in 2024? And are there any bright spots in the industry?
Yeah, it has been a choppy year for sure. I would say, through the first 3 quarters of the year, the numbers out there in the market are about 25% off of where they were through this time last year. And we're probably right around half of the peak numbers we saw in 2021, if you can believe that. But the good news is that in Q3, it really does feel like things have started to pick up, and there have been some really interesting deal announcements out there. Q3 was actually about 17% busier this year compared to last year. And we've seen a lot of strategics get back in the mix. Companies like IBM, Cisco, Thales, and the tech space announced billion-dollar-plus transactions. We've also seen some bright spots in healthcare and life sciences, which we know really well here at Cooley. Horizon sale to Amgen just got through the FTC process, clearing those regulatory hurdles. Pfizer announced an acquisition of Seagen that was very sizable, all-cash deal, showing that there's really a lot of dry powder, not just in private equity, where people always use that term, but on the balance sheets of big pharma as well. And it does feel like, just anecdotally here in the trenches, that a lot of those companies are keeping their pencils sharp, looking at opportunities and starting to potentially move ahead on transactions. So I would say it's still too soon to say whether Q4 will show a return to normal, but there's a lot of optimism as we look ahead into 2024.
Excellent. And let's think about how are companies pursuing it? Are they pursuing multiple paths in parallel? Are they getting creative? What are some of the things that you see CEOs and boards execute successfully to win in this environment?
Certainly, we have seen a lot of creativity in this environment, which look, I think that makes it a lot of fun from my perspective. Everyone loves, obviously, the busy years with a lot of mega deals where it's just kind of one after another. But sometimes in this environment, having to think about CVRs and earnouts, rollovers, creative structuring, really trying to use creativity to bridge valuation gaps or accelerate timing and get deals over the finish line is something that at least I personally really enjoy and that we've been seeing a lot in this environment. I would say the other thing we've seen, which you alluded to, is a lot of companies parallel pathing multiple potential strategic alternatives as they try to figure out what is going to be achievable, and they try to navigate a fairly unique environment in terms of navigating their capital structure, liquidity requirements, looking for growth, potentially through acquisition in a fairly low growth environment. We've definitely had companies come to us and say, we really want to keep these three potential options warm, but we need to think about how they compare and contrast on a number of dimensions, like shareholder approval, regulatory approval, timeline, board duties. And so we're actually going to be putting out a blog piece on this on our Cooley M&A blog that'll feel very timely. And again, that's a situation where just making sure that you retain that optionality as a company to, if you have option A, B, and C in front of you, not get too far down the path on one before you know whether you want to potentially pull the trigger on the other. It's part art, part science, and something that we're seeing a lot of companies juggle in this environment.
Let's now shift to the regulatory landscape, which oftentimes affect M&A activity. What have been some of the regulatory concerns that you've seen impact either deal terms or negotiations?
Yeah, antitrust is front of mind for sure. It's been an environment of enhanced antitrust scrutiny and frankly enhanced antitrust rhetoric coming out of the DOJ and the FTC. It's been like that for a few years now, but even over the summer, we saw revised draft merger guidelines come out that advanced some fairly novel and unique theories of antitrust enforcement. A couple weeks ago, the head of the FTC published an op-ed in the Financial Times calling into question serial acquisition strategies, which obviously is an important part of the growth plan for a lot of companies across sectors and in tech in particular. But that said, deals that are getting challenged still are getting through. I referenced the Horizon Amgen transaction. At the beginning of the year, we also closed Amazon's acquisition of One Medical, which obviously was scrutinized, being that Amazon was the buyer. And so we really just see, I would say the primary impact is people really focusing upfront on the risk and potential impact of timelines of an antitrust challenge, what the buyer will and won't be required to do, whether that's actually litigate with the government, pursue a divestiture or not. And also, I think upfront about the pro-competitive benefits of transactions that you can make sure to articulate. If a transaction promotes innovation or cross-selling opportunities in a way that is good for customers, we're seeing a lot of our clients really hone in on that and make sure that they're digging into those benefits so that they can put them forward as they discuss the deal with the regulators.
Kevin, access to financing was also a challenge in 2023 to get deals done. Have you seen companies turn to stock deals? And if that being the case, what are some of the things that should be top of mind for deal makers considering those types of alternatives?
I have. The cost of debt remains high. I've had a few transactions just personally where the parties wanted to do a deal, but the math just wasn't able to pencil out with the cost, the interest rate that would have applied. And so in some circumstances, companies say, well, maybe another type of transaction, a stock for stock combination, is something worth pursuing that obviously doesn't require the third party debt financing. I would say we're seeing those MOE style transactions more on the private company side. In the public company side, there's challenges in the public markets with advancing the benefits of those to stockholders and really having to go out and sell them in a difficult environment. But on the private company side, a lot of companies saying, hey, we can join forces and come out stronger if we put our two companies and our two cap tables together rather than going it alone.
Excellent. 23 was also a year where we saw M&A being a prominent theme among activists. How do you think about and manage activists as part of the M&A process?
Yeah, look, we could probably talk, for a whole segment just on this topic, but I would say the bottom line is advanced preparation on a clear day is key. Really thinking about how to espouse the benefits of not just a transaction, but your standalone operating plan and what you're doing as an operating matter to shareholders, and putting yourself in their shoes. And actually beginning that conversation with shareholders proactively and building up a record of shareholder engagement where you listen to shareholder feedback and take it into account and are willing to hear those views. Doing all of that clear day advanced prep work is what is ultimately going to be incredibly helpful and lay important groundwork if you're out in the market trying to sell an M&A transaction or dealing with a shareholder activist.
Kevin, maybe one last closing thought here before we go. So capital markets showing signs of reopening. How do you see this impacting M&A activity as we go into 2024?
They're definitely showing signs of reopening, and knock on wood, that will continue. We've had the Instacart IPO, ARM, a number of IPOs in the life sciences space. And I would say that when companies go public, they potentially gain, if not a war chest on their balance sheet immediately, access to the public markets to raise that, and that can potentially be deployed for M&A. They also gain listed, publicly traded stock that's a very attractive acquisition currency for targets. So that is something that I think will be a positive sign for the M&A markets as well, if that potential early trend continues. And look, overall, I would say it feels like while the environment is still choppy, we may potentially be hitting an inflection point here as we get to the end of Q3. And the next several months should be very interesting as we look ahead into 24.
Excellent, Kevin. Well, thank you so much for joining us and sharing your insights.
Thank you. Have a good day.
Thank you. And thank you, Cooley, for making this conversation possible. Kia, over to you.
Thanks, Fabricio. And our final guest today is Senior Managing Director at Leerink Partners, Robert Manier, joining us from New York City. Hi, Robert. Thanks for being here.
Hi, Kia. Glad to be here.
So to get us started, can you describe to me what the healthcare M&A is like right now? Are people buying? Are people talking? Are they closing transactions? What's happening?
It's an interesting time. It's been a relatively slow start to the sort of post Labor Day time period. There's been, in terms of transactions actually getting signed up and closed. There's activity out there. There's plenty of transactions for people to be looking at, and plenty of assets that both private equity and strategics are sort of rolling their sleeves up and looking at. In terms of translating that activity around potential deal flow into actual executed and signed and closed transactions, it's still relatively slow for a multitude of reasons. Probably the largest of which is the continued prevalence of a fairly substantial bid-ask spread between buyers and sellers, particularly on the private equity side, just given where we're at with the current debt paradigm versus where it was 12, 18 months ago. Debt is obviously a lot more expensive. Leverage levels are lower. There's been a material impact on buyers' valuation appetite versus where it was in early 22 and 21, when everything was on fire and every deal was very competitive and happening very quickly and on aggressive timelines. There's been a pullback from that, and as I say, buyers are always very quick to reset their mark to a valuation level significantly lower than it has been in the last, as I say, the last 2 years. Sellers have been slower to come around to that. I think what you're beginning to see is some of that open up a little bit. There are some transactions that have started to get done, and it certainly feels like the momentum is shifting more towards transaction volume really picking up, and certainly into 2024, a lot more activity planned, driven by the narrowing of that spread, and also a lot more pressure on the funds to deploy capital.
Mm-hmm. For the deals that have been happening over the past, let's say, year, what has been behind that? What's been driving it?
It's somewhat sectoral specific within healthcare. There are a few subsets that have been very resilient in a market which for a long period of time people were expecting at least some form of recessionary pressure, which sort of didn't materialize certainly to the extent that was anticipated a year or so ago, when the Fed's ramping of interest rates really got pretty aggressive. I'd say there's as I say, there's a few subsets. Pharma services in particular has been very resilient, and a lot of activity been done. Even very recently, some very high multiple transactions being done in the CRO space, and other areas touching pharma services. A lot of the drivers around that have been just because of the nature of the market and the visibility that those companies have into their future cash flows, long contracted revenues, etc. That's generally very resilient, and the lenders have actually been very keen to lend into those situations. So again, that helps bridge that gap. Value-based care and anything that touches taking costs out the system, and a capitated model alongside that with a proven model to execute on, has been very resilient, both from a growth perspective as well as change of control transactions. And then I'd say certain other areas around specialty providers, again, where you take out some of the stroke of the pen risk from whether it be Medicare or state Medicaid budgets, and rate cuts. There's been areas that have been active, but they've been more dominated towards those that are more private pay, cash businesses, and commercial insurance in very resilient sectors.
Speaking of government, what regulatory areas have been top of mind or having the biggest impacts lately? Is it antitrust or drug pricing, something else?
Yes, look, I think there's no escaping the fact that the FTC is being much more aggressive in how they're pursuing transactions and how they're reviewing them. In some cases, actually even talk about retrospective action on previous approved transactions. We haven't seen that necessarily yet play out, but there's certainly enough talk around the hill on it. I'd say it's not just historically a case or consistent with historical cases around strategic acquirers being those that are sort of more concerned around sort of the competition risk and how the FTC is going to view market sizing, competition within that market, and therefore how they view sort of the antitrust side of things. It's gotten a lot more aggressive for how the FTC is looking at it, and a lot more scrutiny on the strategic acquirers. But that's also shifted into private equity acquirers as to whether they have an existing portfolio company or not. Just more scrutiny around pricing and sort of building areas of concentrated power that could potentially look like having undue influence in pricing in local markets and things like that. Like the FTC has begun to focus on that. They've been making sort of a lot of noise recently in the press around some of that with some situations. So when sellers are thinking about exiting assets, whether it be to a strategic or whether it be to private equity, first and foremost in a lot of people's minds now is ensuring that they involve counsel early in conversations and discussions around some of these elements, so that you're properly prepared for how you should be thinking about the FTC's reaction to a transaction announcement, whether it be to a strategic or private equity, how they're thinking about leverage, how they're thinking about certain situations. And California, for instance, has some rules in place around private equity ownership around physicians, and there's a focus as to, does that bleed out into other states who follow suit, and how does one deal with that going forward? So it's first and foremost in a lot of people's minds in any situation is ensuring that you're properly prepared for sort of the new approach and the current approach that the FTC is taking.
Have you seen any companies maybe walk away from deals or walk away from conversations because of antitrust concerns, or no? Lately?
Yes, very much so. I'd say it continues to still be an area which is more of a focus when you're talking about strategic acquirers, and how particularly the larger public companies, be it the payers or other of the larger operators in and around the healthcare ecosystem. There's just a significantly larger amount of scrutiny on those. So therefore, sellers in those situations are looking for an awful lot more deal protection mechanisms included in transactions than they would have done historically, purely because it's almost expected that in a lot of strategic acquisitions, I would say more likely than not, but certainly there is a lot more of an expectation that there will be more review, more scrutiny put onto transactions. Therefore, you're getting to situations that there's an expectation about second reviews and therefore a delayed timeline between signing and closing.
We're 45 seconds to go, and this would not be a deal-making conversations if I didn't ask you about AI, or is that coming up in a lot of healthcare deal-making conversations? Are companies trying to buy AI capabilities to stay, ahead of the game? Are you seeing that?
Very much so. And I, for one, was a little skeptical for a while until we tasked a team here at Leerink to do a real deep dive into the AI opportunity and capability across multiple parts of the healthcare services ecosystem, as well as the biopharma and biotech side of things. And it's an enormous opportunity. The evolution of the technology and the capabilities around it are staggering in terms of how quickly things have developed. You see it just in general everyday press around what has happened with ChatGPT-4 and how quickly that is evolving. There are an awful lot of companies who are prosecuting aggressive build out of AI strategies and doing it very successfully, very quickly. And I'd say for the first time in my 25-year career, you're seeing technology investment yield real discernible cash benefits to a company's cash flow and income statement very, very quickly, because this technology is very sophisticated if applied properly, and is generally turning up a lot of opportunities, which other technologies and other situations where human interaction and human sort of early stage work is required in order to identify those opportunities. AI is doing an incredible job of taking this enormous funnel and filtering it down into something very real, very quickly. It's a staggering development, actually, and it's happening very, very quickly. And as I say, I think there's a lot of people who are skeptical around it just being a lot of fluff and bluster, but it's happening very quickly. And I think you're going to see more and more of that be prevalent. And within the next year or two, it is certainly going to be an area where some of these smaller companies that are purely developing AI software tools will be targets for some of these larger companies in particular, because the leverage they can get across their platforms for this sort of technology is genuinely staggering.
Sounds like we could talk about AI forever, but we're totally over time. But thank you for being here with us today.
Thank you for having me. It was wonderful to see you. Thank you, Kia.
Thank you all for joining this afternoon for another Axios Dealmakers event that has made everyone smarter, faster. For more on what's next for M&A or to sign up for the Axios Pro Rata newsletter, visit axios.com/newsletters or go to the Axios app. And be sure to tune in virtually next week for Axios' BFD, where we'll bring you exclusive conversations with industry leaders who are driving the headlines, markets, and the most consequential deals of the year. Thank you all for joining, and we'll see you on axios.com.